Hi everyone. First of all, I would like to thank to Team Valuationary for doing the wonderful job for creating employment opportunities, making the students learn, and creating expertise knowledge in the valuation domain. That's something the valuation team is doing extraordinarily well, and I've been really blessed to be the part of this team. And so today in this particular session, that being especially being curated as a startup valuation, like what are the key dynamics, what are the key functions that we need to look at while valuing any startup. Generally, when we say like we need to value any startup, it's itself is a difficult job, I would say. The question is like, because I don't have any background, I don't have any past history, past record through which I can look into what the trend line is, how the company was performing, whether the management is actually able to deliver or not. I have nothing to look at. The only thing I need to look at are the promises, the rosy word of the promoter, the business model he's talking about, the future roadmap, and the business plan that he has. So these are the few things that we can always look at. But we need to have, as a valuer, I've been saying that we need to have a very cautious approach while doing the valuation for the startup. The first and the foremost thing that comes even before the startup is who is the promoter, who is the founder of the company, what sort of value he holds or possesses, what sort of credentials he has, what sort of expertise he has, and whether he able to create that marketplace or not, whether whatever he is saying, whether he is able to implement that thing or not. Okay, so the promoter is the most important person, the founder, the co-founder. These are the people who have conceived the idea of framing something, starting something, and now we need to, and while making investment, suppose as an investor I've been talking about, before making investment, the name of the startup does not matter more, but what matters is who is the person behind that. So suppose, take example, Mr. Sundar Pichari, he suppose says that I will be starting something as a startup, and because that person knows everyone know him, and he is well connected with the investors, so it's been very easy job to get the funding done if he is doing something based on what sort of credential he hold, what sort of knowledge and expertise he hold. Okay, so we can say blindly like, okay, because he is coming up with something and I don't want to, as an investor, I don't want to miss the bus, so I should be the part and parcel of their business, I should take certain stake in the business. But when you being a person whom nobody knows much, but I being into the job earlier, and now I being starting something on my own, or I being the graduate and I being starting something on my own, then I need to focus upon the key skill sets that whatever I possess. If I lack those skill sets, then I can appoint somebody as a co-founder or a person who can come along with me and bear the responsibility, work as a team, and together we can add value to the company. So this is the most important thing that we need to look at. Then we need to look into like what the team size is, what sort of technology the company is possessing, whether the team that you are saying that is resourceful enough to create a value for that particular product or service that you're talking about. So these are the certain qualitative factors. It is like before even moving to the financial terminologies or the financial terms or the financial projections, most important is to look into these qualitative factors. And one important dynamics is like, what is the segment or the sector that you're talking about. Every investor may not be interested in making investment in every sector, because people are sector agnostic. Few investors make investment based on their knowledge about a particular sector. So we need to look into like who may be the right set of investors before even talking to the investor lobby. Okay, now the question that arises is, from suppose as an investor, what he looks at into the company. Of course, everybody says that they looks into scalability of the company, business model, business plan, and future roadmap, promoters profile. Of course, these are all the ingredients that been there. But again, what is needed to be looked at is like what is the market size, overall market size of that particular segment. What are you talking about? What percentage of that market size you want to like exploit in the market, and then what sort of like the future roadmap or the projection that you have built in. Now when I say projection, it being very easy to say like I will take just 10 years numbers, and based on 10 years or 5 years or 3 years numbers, I will come to some discounted free cash flow valuation methodology, and then we say that this is the value of the company. I would say that that may not be the right approach, because whenever the promoter is providing the projections to you as a valuer, the valuer need to look into like validate those projections. Now that is a very difficult question to say. How to validate the startup? Because validate the projections of the startup, because there is no comparable company which being a listed peer companies which I can easily go and browse and say that okay, these are the profit margin, these are the ratio analysis, and these are the trend line of the listed company, and based on this the company will go like this. But again, there is a silver lining in that. What we can look at, there may be certain few companies which may be into this, that is started segment what you're talking about, that may be a peer company and which has already traveled a certain milestone, or travels like they got funding, and few series of funding they have already like, and now we need to see like we can go to Ministry of Corporate Affairs mca.gov.in and download their financial data, and see like how the financial data numbers, that when this company which is my peer company and is still being a private company, what is the course that this company has traveled, what sort of like initial revenue when they have got the first level of funding, what is their sales at that point of time, and in the time when they got the A level funding, what are the sales. So all these things we can look. Now we being now in a better position to validate like the way what you are projecting and the way the actually the company has grown, we can always compare and look at. So that may be one way to validate the projection and the business model of the company. Another thing, like very cautious thing, like people generally comes present the projection and saying that this is going to be my future roadmap, but the question is it may go like a rocket. They say that it is going like this and this, but whether those things may really be achievable or not. So we need to first of all see if something is going like a rocket, then there may be a lot of competition that may be called upon, because everybody will be then looking at okay, this is a segment which has a lot of sweetness there, and a lot of profit margin is there, and everybody will be moving into that particular segment, and then the profit margin will finally cut its down. Okay, so we need to have a cautious approach while looking into the projection line. Another is like we should not just apply the pure play DCF methodology. We need to look into like applying the two-stage model, that is basically like an H model. And the H model, when we say, we look into like okay, for the initial explicit 5-year period, this is the projection. Then after that, again, I'm not just bringing applying the Gordon model and saying that this is the terminal value. What I've been doing after the 5th year, I've been again projecting forward for another 5 years through a H model. It is not like line by line, but through use of the H model, I will able to bring the value. Suppose if I say that till the 5th year the growth was in the range of 40%, it was the company was growing, then I would say that maybe forward 4-year, 5-year, after the 5-year, it may be growing with the 15% level, and then I will bring down, and after those 5 years again I will bring it down again to the level of 5% or 4%. So that is how we need to look at while applying the two-stage model, and that may be more helpful because it will be helping us to at least capture the growth, entire growth, factor, or even the entire years for the growth of the company. Okay. Then another is like the question that may be debatable is because the projection that the management provides, that may be the most optimistic projections. So whether we should rely upon that or we should apply the Chicago methodology. When I say Chicago methodology, generally talks about different scenarios. It may be the optimistic scenario, it may be the pessimistic scenario, it may be the most likely scenario. So what I would do, I would look into the projection, I will apply certain probability factor to these scenarios. What it may be like, I would say like 50% chances that it may be the most likely, 25% chances that it may not be most optimistic, whatever you are saying that may be correct, and 25% that the company may not able to perform well. So we look into this, then we apply into the probability factor, and then we say that okay, the value of the company is this much. That may be the most common thing whenever we need to discount the value for the startup, and not majorly discount, but want to bring the fair value, like based on market dynamics. It may not be 100% success. It may be like the most likely, the optimistic and the pessimistic scenarios. Based on that, what should be the value of the company? Okay. Then there's another concept when we say venture capitalist methodology. Under this, what we generally look at is the venture capitalist mindset is, suppose if I make investment of $1 million with a return expectation of 25% IRR return, and for 5-year period, tenure I've been making investment. After that, I will take an exit, and 10x return I've been expecting. At the initial point of time when it is making investment, it is $0.5 million, suppose is the revenue line, and after that 5-year period, the revenue line suppose 1.5, or not revenue but the profit line is 1.5. Then I would say that based upon this venture capitalist methodology, what the dilution level they are looking at is somewhat close to 20%. So the venture capitalists will be looking at, okay, I will make $1 million investment, but I need at least 20% stake in your company if I make investment for a period of 5 years with 25% return expectation. So this may be the crux that needed to be looked at, needed to be understood. So after all, I would say that valuation is an art and a science, and just by applying the science, you cannot value anything. It is the qualitative factor, it is the knowledge, it is the experience, that whatever you possess over the period of years, that will be helpful in understanding like what are the key dynamics of the business are, and how this business in time to come will able to achieve or perform into the real life market. So that's all from today. Let's meet some other day for another session, and thanks a lot, and thank you.